Now we have its next session. Financial statements review from the lens of a stakeholder. We have the speaker, CA A M Chinmaya. He is a partner in Agraha Advisors and Agraha Valuers. He is a speaker in professional forums on topics of valuation, tax, and regulatory aspects, practice building, and leadership. Valuation course curator in online platforms for professionals in the finance space. Frequent speaker in several forums on including ICA, ICSI, Ideals, Bangalore Valuers Organization, etc. Written articles in the journals and publications of various institutes. He is a chartered accountant by profession, Bachelor of Commerce from Mysore University, graduated company secretary, certified forensic auditor, and registered valuer. With this brief introduction, I request CA Manjunath Bangalore branch secretary to escort the speaker, Chinmaya CA AM, and present a floral bouquet to the speaker. Over to you, sir.
Firstly, thank you, Bangalore branch, for facilitating the stage and providing me opportunity to address you on this topic. Am I audible now? Is it better? No. Is it better now? Okay, great. So thank you, Bangalore branch of CAC for facilitating this and providing me an opportunity to address on this topic. So had been seeing the schedule since yesterday, right from. I think, is it okay? Okay, sure. So since yesterday, right from Mr. Vijay Raja's session in the morning, and then now MPV. All are, I mean, they with their experience of decades in regulations, Companies Act, provisions, standards, accounting standards, with everything, it's a very heavy load of very deep dive into the subject matter. So right now we need to, but this topic is slightly divergent from the flow what was happening. And so we need a slight, possibly a kind of little icebreaker or something to set ourselves a little differently. So this session, to give a broad outer view how this flow happens of this session, about 1 hour 20 minutes or so. So this will not be very core of the laws and regulations. Of course, a lot of laws and regulations will be covered, but the intention or the objective of the session is not the core of laws and regulations, but the objective of the session is how these laws and regulations, what we have, is reflecting in the company's requirements and the stakeholders' requirements. More so in the financial statements. In the session and the entire 2 days is about the Companies Act and financial statements. So in the regime, I mean, in the realm of financial statements, how different laws are applicable. More than how different laws are applicable, once that is all applied, now we have a financial statement, how that will imply itself to a stakeholder, how a stakeholder views a financial statement, what is required, what is not required in that. Is what financial statement looked at by any of the stakeholder, is it serving their purpose or it is not serving their purpose? If it is not serving their purpose, what is required? So broadly, this is the session all about. So quickly moving on, okay, financial statement means we'll see these 4 aspects. When you see the stakeholders, many times we will not even think as to whom we are addressing to. So we are doing the audit, company is closing the books, but to whom the books is for? Who is the books is for? We are doing audit, will help the company in doing accounting and several other things we'll do. But are we conscious? Why are we doing this? Is it to file with MCA? Is that the, it's for the shareholders? Yeah, one of the stakeholders is for the shareholders. Anything else? Sorry. Main stakeholder of a company is shareholders. Yes, for shareholders. I mean, what all we are doing is for the shareholders is what sir feels. Anything else apart from that? Financial institutions, any lenders, maybe who is there in the company? Regulatory authorities. Taxation is also a regulatory authority. So yeah, a little bit of listed customers, creditors, vendors. We don't think too much, but at least after IBC, we know how important creditors are. And employees, of course, many a times, especially if the employee is having, generally also an employee would want to know how the company is with which the company, I mean, he is associated with. More specifically, in terms when they're having ESOPs or any other compensation, it will be far more direct and relevant. Government agencies, trade unions is okay, minor, and investors, suppliers, and media. So broadly, this is the stakeholders which we talk. Generally, we don't think too much about, okay, why is this required? That's actually all of us should take a step back and see, okay, when we are next day tomorrow, when we are going to the company, okay, why are you going? If we are going for an audit, what is the objective? What is the completely end role of it? I used to say this when somebody asked me a line or a kind of a transaction and say that is it taxable. So when I used to discuss in the office, I'll say, okay, if it is taxable, so under what section? Let's say if it is told as let's say 28 or 40, business income or companies act, if capital gains, if it is told, okay, if business income, then what section again? Then they'll go to charging section. Okay, if charging section, then what next? Why as a common man, if I ask, I have a earnings, I have business income, then how as a auditor or a I mean chartered accountant, you explain me as to is it is taxable? I can, the question may start arise from why should I even pay tax? So maybe in the same way, if you start thinking like first you will say business income and then let's say section 28, or if it's capital gain 45, whatever charging section, then okay, why do you need to see 45 and 28? Then maybe you go to section 5 and 9. Then why do you even need to go to section 5 and 9? Then you go to section 1 as to, I mean, that's where it is there. No, I mean, otherwise there is no meaning of 28 and 45. And why even I need to say go to section 1? Maybe you need to refer a Constitution of India as to, I mean, if you are there in India, then if you are abide by Constitution, then you're also abide by section 1 of income tax. And then section 1 says as long as the scope is covered in 5 and 9, then you need to see whether 28 or 45 or whichever charging section is triggered. Then once it is triggered, then you need to see whether it is taxable or not. So this is the broad, I mean, right way of looking at any law for that matter, not only income tax, any law for that matter. So in that context, I mean, this is an example as to how you approach one aspect holistically. Generally, when you say, when somebody asks you it is taxable, you just go to that end provision of 28 or 45, but our flow of mind our mind should flow in this thought process. So similarly, this is just an example. Similarly, any activity, let's say when I'm approaching a valuation, if I need to do a valuation, first thing which comes to my mind is, okay, who will read my report? After preparing everything, who will read my report? That also will drive the way I make the report, the way I do the research, or the amount of backup papers which should be required, both practically, logically, as well as from the law perspective also. The final objective will determine the steps for me to take it forward. So that is why this question, who is the stakeholder? Why are we doing this activity? Why are we doing this work? So slowly we'll move on to see as to why it is a lot more relevant and required in our day-to-day thought process, the stakeholders. So as I said, little bit ground setting is required, as we have all been used to think about the law, act, income tax, companies act, stamp duty, GST, all the laws. We are thinking about the laws. So little bit ground setting is required for this session as to what some of the myths we may be thinking, or some of the preconceived notions we will have while we do the work. So let us little chat about a few aspects which will bring us to ground, or slightly take us away from the laws and regulations. So one quick question: anybody trade in stock market? Okay, sir trades in stock market. So the next question: what is the basis you take your decisions? If you want to buy a company share, what is the basis on which you decide to buy or sell? Moving average of stock price, is it particular company? Let's say last 1 year, how it has moved. Let's say if it has been falling from last every month, it has been falling 5%, 5%, 5%, then you will think that you should not buy that. Okay. If it is keep on rising, then you will decide that you need to buy it. Okay. Any other thoughts? How do you financial status? How will you get to know the financial status? By reading reading balance sheet and P&L. Okay. Okay. Accounting ratios, is it? Well, firstly, net worth and other accounting ratios. If it is If it is solid, if the company looks to be a very healthy balance sheet, then you will feel like you can buy it. But if you already have a share and if it looks that the balance sheet is not very healthy, maybe you'll just take a call to sell it. Okay, this is another way of deciding to, yeah, a part of fundamental analysis. And sure, any other way?
What a short-term gain with the low value stock.
Okay, low value, how will you know it is low value? So if the price of the share is low, I want to just take an example. There's a company, one of my clients also, near.com. So it recently listed in US stock exchange. The value is $1.7. Okay, anyway, any stock, let's say if it is trading at 10 rupee, 11 rupee, is that low value? Depends on the P ratio. So what is the P ratio you see? Whether what? Okay. So if the industry P ratio is about 15 and this P ratio is about 19, then you will not buy that company. Yeah, other factors you'll consider, but the way you take decision based on P ratio is, what you mean to say is when the P ratio is lesser, you may come to the conclusions we need to buy the stock, right? I mean, I'm saying other things remaining constant. If all other aspects what you see, I'm just taking from your point. Yeah. Yes. Any other aspect? Sorry. Minute. What is the quality of management based on that? Yeah, sure. Yes, sure. Any other parameters? EPS. Yeah, all the fundamental analysis of the company will come in one bracket. Yeah. Yes. Got it. Think for a moment. By using these parameters, if we study all of these parameters for a company and invest and try make money, two questions you don't need to answer. One is from how many days, years you are doing it, has it given you the result, complete successful result, or you've not been successful in spite of doing all of these analysis. Think for a moment and hold your thoughts with you, whether all these aspects, let's say moving average price, if you see, or the balance sheet analysis you do, P ratio you look at it, or see the management team, or even read the let's say information memorandum or the investor analysis, what people would have done. So read those memos and then do the investment. And after doing all of this, you just think over what is the amount of time required for doing all of these things. Simple, very simple. I was for preparing for this session, I wanted to look at the financials of one of the startups in very detail. One came to my mind was Byju's, other one was Flipkart. So just I went to started yesterday morning to see Flipkart financials. I realized that, okay, only from 2013 is available, older is not available. And after that, there are 8 group companies are there for Flipkart. We need to each one distinctively see. Otherwise, I'll become a fool by just seeing one financial statement, definitely. So, and then that financial statement is in XML format. I don't have the tool of XML to convert. So all these things happen. So I said, okay, leave Flipkart. I'll see some other company. I mean, it's just an example, random example. I'm not saying that it is very difficult to analyze a financial statement. I'm saying how much efforts is required for anybody to understand a company, not just downloading financial statements. You download, you analyze, you understand, see the history, last 3-4 years, what happened, what other peers are doing. So all of these things to know, it takes a lot of time. So all of this time, what does it take? Is it worth to take the risk and earn money? Whatever money we can make, is it worth to take? So let's say in 2014, we did all the analysis, very extensive analysis, and bought Maruti Suzuki. Everything was right. All our analysis was perfect if we have analyzed Maruti Suzuki in 2013-14, and we thought we'll need to buy. Definitely in 2-3 years, the lot more inroads of EV and other things, which nobody thought that in 2012, 13, 14, it will be that impact that entire automobile industries will have an impact. Everybody were thinking automobile is something very safe and decent returns for sure will be available. That's why P ratio also was slightly higher on all the automobiles. It was not like 12, 13, 14 like Infosys or not Infosys, but it is not like maybe an FMCG or any other or mining or coal, those kind of sectors where it is very low P ratio. So automobile was a comparatively higher P ratio, but still people would have bought by doing all the analysis and forecasts and everything. But in a couple of years, you realize that there is an EV domination and everything. So definitely anybody's decision would be very flawed, and they would have lost the money unless a person would have thought that, okay, something EVs in the cooking, so definitely something strong will happen. I mean, ESG and environment and everything. If somebody would have thought like that, okay, definitely electric vehicles and that space would take over, and automobiles industry would not be having a great future, then they might have gained profits. But in my experience, there would not be anybody who is that smart, because however we are smarter, definitely the management team in Maruti would be much smarter in their own domain. In the automobile sector, they will be more smarter than us. Obviously, they would have, if something was slightly visible also, in case, I mean, slight future estimation could have been done about EV, definitely the people in Maruti, Suzuki or a Ford would have done that much earlier than what we would have done. So I don't think anybody can make a huge money by reading the financial statements. And if you have a different thoughts, we will discuss. Everybody may have a different thoughts, but overall, I mean, my view is generally when you the amount of time is required to spend on analyzing and everything, and versus the returns what we may earn. I've not seen anybody who has told that by doing fundamental analysis, I made a huge amount of money. There may be few exceptions, it could be there, but in general, I'm saying. Anybody invested in startups? At least the first question was clear. Whatever points you told, that is all available for the first question. Like previous financial statements are there, trend analysis can be done, balance sheet can be seen. But startups investing is, I mean, all of these may not even matter in case of startups. Anybody has invested in startups in the gathering? Not even one person? Risky, definitely, of course. Wherever risk is there only. I'll come to that point of risk. I have one slide which will, I think it will just show you what is the context of a risk. What is the meaning of the risk? When I got this thought about 2 years back, I got this thought, and I've used that slide in all my sessions from that time. So the entire thinking about the risk will change when you see that slide. But very valid point, risk is very high, but okay. Seems like nobody has invested in startups. Have you invested any company which has exposures to startups? No, is it? Like InfoEdge and all of that? No. So, but all of you would have some exposure in your practice to startups, right? I mean, any of your clients would be startups. That is true. If the answer is no for this, then I will assume that definitely everybody is sleeping. Because in Bangalore, if you're not working for a startup, then definitely you're not practicing. Okay, so what is, okay, can you, I mean, at least because you would have seen the startups balance sheet, financials, their performance tally, you would have seen their transaction, at least you would have seen their funding, like you would have got astonished. Okay, I thought they're simply burning the money, they're simply passing the time by doing video calls and this, but all of a sudden they got $1 million funding. How is this possible? Definitely all of us would have got this thought. So have you tried analyzing as to, okay, why they got 1 million funding? Why was the company which had nothing got some 50 crore valuation at least? Or ignore about other things were celebrated in media, but the clients, what we would have seen, even we would have thought, okay, what is there in the head of that investor to just put the money where nothing is there in the company? We would have thought like that, no? But okay. So if you have thought like that, if you're not invested, at least if you have thought like that, at least if you visualize those scenarios, then this is the session where we try to understand how this happens, why this happens, and from the financial statements, looking at the financial statement, how we need to do so that we are quite nearer to the decision making. But one thing, be sure, shamelessly, we should accept that whatever is working is truth. We can't keep saying that stock market investments, simply people are putting money because they don't know, because they will, in the greed, they are putting money. 2000, just after pandemic, when the markets started raising, even, I mean, everybody thought that it's very risky. Some of the countries did not, stock market did not move, but India started moving. And I thought maybe it's about 2-3 months again, it will fall from about 25,000 of the bottom in the Sensex to it started moving, and 30, 35 happened. I thought maybe this 30 was the previous high pre-pandemic. Maybe it has come back. So seems like pandemic will not have any issue. So it has come back. So it went to 40, 50, 60. So I don't know where it is going, but mind you, it has happened in the past also. But now other stock markets are not as moving as rapidly as this. So maybe we think that okay, foolish people are investing, so it is. I mean, value is going up. But after 5 years also, it will go 1 lakh, 2 lakh. It will go. Then we'll think that maybe they were not foolish. There was something which we were missing. It is for sure. It is not that. I mean, there is no reason for us to think that okay, why we could not identify. That's not our field. We are chartered accountants, and we know how to comply law. We know how to. Our best expertise is to advise the clients in seeing and knowing as to what is the best way they can comply with the law, and they can meet the fair disclosure of the financial statement. That's what is our forte, and that's where we are very good in. However, it would always be good to know a little bit about the other side also, even though we don't need to become experts in that, but it will be a little better to even know from the other shoes also, instead of simply thinking that okay, we are good in what we are and others are foolish. So we can an attempt to see a little bit from the other lens, somebody else's angle also, why it is risky and stuff like that. So okay, this is one place. It's not for too much significance, but in the later slides it will come. Somebody is asking what is the price of it, and the other person is saying some price, and the guy is asking, okay, made in China stamp is there in the bottom. Then the other person is saying, yeah, because made in China stamp is there, value is low. Otherwise, value would have been quite high. So similarly, you see, this is a very simple. A vessel is there. How do you value? So that itself is little difficult to give a value. To give a stamp of the value. This is what it will cost for the vessel. So then balance sheet is there. I have consciously told poor balance sheet for various reasons. I'll explain. So when it is very difficult to assign a value to an object in your hand, how can you assign a value to a company, which is, a balance sheet which is representative of a company? How can you assign a value to it? Can the financial statements, what is there in front of us, is will make justice for us to show the health of the company? With that, can we value? With that, can we take this decisions? Can we means for a moment, whenever we are talking about ourselves, assume that you are stakeholders and you're not auditor of the company. You are any of the stakeholders, either investor or shareholder or employee or whoever. You are the stakeholders and not the auditor of the company. So the question is, by looking at the balance sheet, can we take any decision of that company? So this is one balance sheet, which you will know very well. Everybody would have seen, definitely, at least if you are doing stock market trading, definitely this company would have come in front of your mind. And if you have tried to do little bit fundamental analysis also, you would have seen this balance sheet. Some of you may already know this balance sheet. These all numbers are in crores. Just see the first column, March 23. So total shareholders value is 5 lakh crores. Current liability is okay, we don't need to too much the current liability. If you see the balance sheet, current assets is 3 lakh crores, fixed assets is about 3 lakh crores, non-current investments is about 3 lakh crores, and current investments is about 3 lakh crores. So totally 9 lakh crores is the balance sheet size. I think you know what is this company now. So net worth of the company is about 5 lakh crores. Revenue of the company is about nearly 10 lakh crores. Market capital is about 17 lakh crores. Can we draw any inference from this? Can we buy this company? Can we not buy this company? Financials are there in front of us. Market value is there in front of us. Can we take a decision? Can we buy this? Can we not buy this? Sure. Let us see. I'm not expecting answer, but just for you to think through. Okay, in what way can we analyze? This is very basic way of starting the analysis, right? Very, very simple, simplistic step in analyzing. So I've added in this slide RIL. RIL is the company, you all know. So now just one more thing. So the value of the company was, market value was about 17 lakh crores, and as I told, net worth is 5 lakh crores and revenue is 10 lakh crores. So is it okay? If we are not able to take a decision, can we invest? So next thing information I have presented here is their earnings. What is possible earnings? What is there in serial number 1? Year 1 was the last year, was just less than 50,000 crores was the earnings, revenue, not revenue, profits. So if you think 1 year profit is 50,000 crores and market value of 17 lakh crores, can you take a decision? This is just one more input I'm giving. First it was balance sheet. Now we got one more input. Okay, because from balance sheet you can't make out. Okay, simplistically if you take it, okay, so today's balance sheet is 5 lakh crores. How do I know whether 17 lakh crores is right or not? So what you need to know, what this balance sheet can generate. That is the next question, right? You can take a decision by seeing what this balance sheet can generate. So this balance sheet can generate 50,000 crores a year today. Can we take a decision based on that? It's not possible. So we need to know what is the forecast. So I've taken last 4 years, 5 years, annual growth rate of these profits. So it was about 7%. Reliance has grown by about, I think last 5-6 years I've taken, Reliance has grown by about 7%. Reliance profits have grown by about 7% every year. So I've then listed out in the earnings column by increasing 7% every year. So if we increase 7% every year, in about year 18, we will get 16 lakh crores. Yeah, if whatever it was growing in the past, in the same trend, if it continues, profits continue to grow, I will need, even after waiting for 18 years, I'll not take back my money. Because market value is 17 lakh crores. It will require 18 years to reach, with 7% growth rate, it is required 18 years to reach 16 lakh crores. I'm not even getting my market. When you look at this perspective, would you want to buy Reliance? Just from this, I'm not going to any other. You can say that multiple other factors is required, all of this. Just by looking at this, definitely you will not buy. But otherwise, the general hypothesis, general theory is, okay, even if it is 5% less, I can buy Reliance. Reliance is something very, very fundamentally very strong. If it collapses, India only we should collapse. Then only Reliance can collapse, because they're there everywhere. Whatever you see, they're there. So if the economy collapses, only Reliance can collapse. That's the general sentiment. So I can say, okay, even 5% the market price down, I can buy Reliance. That's a general sentiment. But looking at that fact, this fact, and these are not made up cooked up number. These are all right numbers. It's not, I mean, don't think that, okay, maybe some Excel formula error is there or some error is there. It's the right number. It needs 16 years to earn. It needs 18 years to earn 16 lakh crores. This is a common man thinking. One more thing, okay, but actually what is required for us, we should not take actual returns, right? We should take discounted returns, right? Because if you take actual research, it definitely doesn't make any sense by saying taking actual cash flows. You need to take discounted cash flows. So the next column is discounted cash flows. When you see discounted cash flows, the last column I've hidden after row 18, year 18, I've jumped to year 98 because my sheet was not enough to show entire rows. So if you see the bottom value, 8,88,000. What price I have discounted? 12% I have discounted. 12% is the return which is given, and also market return. Today's market return of let's say Nifty or broader market, if you take, it was about 12% annualized return. So I have discounted the future cash flows in 12% return, and even if I go to 100 years, I'll earn only 8 lakh crores as my cash flows. Next 100 years, I'll be earning only 8 lakh crores as my cash flow. Reliance would be earning 8 lakh crores as the cash flow, but the market value is 17 lakh crores. Okay, I mean, now also, again, ignoring all the other aspects, would you want to buy? Definitely no. Now consider all other factors what you wanted to consider. Possibly like Reliance, there can be no other company. I mean, 10 years back, if I have thought that like Reliance, nobody else can build an empire in India. Okay, we have Adani who would have just shown in what way our assumption is wrong. Likewise, there will be 100 things which 100 people will come. So in any way, can I take, it's the most simplest of the stock I'm analyzing. Not the very complicated, not the startup, not the thing, very, very simplest stock. Reliance, which is so matured company, very comprehensive in their market, in their outlook, in the everywhere they're there in India. India is expected to grow tremendously. All of these things is a very simple company, but I'm not able to take a decision. If I take a decision based on the numbers, I would be definitely foolish, because in front of my eyes, I know that Reliance can, in the discounted cash flow, can make only 8 lakh crores compared to whatever it has done in the recent past only. I'm not even taking at the face value, I'm taking this discounted value. So all of the basic things, what needs to be done, I'm doing it right. So it seems like it is not even half the value. But like I said some time ago, definitely market is right. Always market is right. Whatever it is, market is right. That is what has been proven in a long, I mean, from decades and centuries. There has not been anywhere where for a longer time market was wrong. It may be wrong for 3 months, it may be wrong for 6 months, it may be wrong for 1-2 years also, but for a longer time market is always right. Every price will converge in such a way, and you show that, okay, we missed out something, but market had already seen it. But still, market is valuing Reliance at 17 lakhs means 17 lakh crore means there should be something. So we'll come to that. This is one example. We'll come back again to this. So now moving on to one of the very important topic which is being talked about a lot, especially in the last 2-3 months, is the governance issues. I mean, the last 6-7 months also we saw Adani in the larger company, listed company, one of the biggest companies of India also we saw governance issues. Whether it was right, wrong, still is unproved. But one thing which is I felt very happy about Adani is that whenever such instances happen in the past, Hindenburg or anybody else would have made that analysis or thing, and the stock market crash would have happened. Everybody have done either to completely protect themselves, do something, or just continue the crash. See why it is very difficult to come out of that situation when it happens, even though your fundamentals are very good. Like we saw in the previous slide, the valuations of a company is generally much higher than what is the current capability of the company. If that statement is true for Reliance future cash flow is giving me 8 lakh crore and it is valued 17 lakh crore, means it is much higher than what is its current capabilities. If it is this statement is true for Reliance, this statement should be 100 times more truer for any other company. Do you agree with me? So because of this reason, any small negative sentiments, you can't really protect the company because your company valuation is very high already. So really you can't do much if entire negative sentiments around you. Imagine Reliance is trading at a PE about 17-18. For that company, if we feel it is difficult, Adani Enterprises is trading at the PE of 300-350. Just imagine in what way on earth possible you can save your company when such negative sentiments come on you, right? That is why I really felt very happy about the way that steps they took. They were very clear, very simple. Okay, you have issue about my debt and this thing. Okay, let me start. Okay, I'll compromise on growth. Even instead of achieving whatever growth I had forecasted to my shareholders in 5 years, let me achieve that in 10 years. That's okay. But market is questioning my capability to deliver. So you have a problem with my debt. You have problem with whatever I'm assuring you to deliver. It's okay. Let me step back. I'm okay to accept a defeat today. Let me repay before term. Let me repay some things. At least you have the confidence and my share price is protected. My market is protected, because once your share price has fallen, then pressure will start from lenders, pressure will start from creditors. Everybody will start pressurizing because everybody will start getting panicked. So very good decision taken. You repay whatever is possible and then hold up the share price. Even today, we don't know whether they can successfully protect or not. Even like yesterday also, there was some news about US agencies probing and 7% stock fall, Adani stocks fell. So it is not sure as of now whether they've successfully won the battle, but at least the initial steps are very good in terms of what they took in Adani. So we saw the governance issues in Adani. Very recently, we saw 2-3 other startups failing, and Byju's has been an history in the last 2 years. They've been giving case studies after case studies to us to think over what will go right and what will go wrong in a startup world. So all of these governance issues are there. So these are few examples. Again, Byju's, you can't say that there is governance issues today because nothing has very categorically come out of it. There are a lot of symptoms which are coming surrounding that, but nothing concretely say that, okay, this was the mistake they did or this is the wrong they've done. So I think maybe yesterday, day before movement, maybe the first step of it, the auditors resigning it without too much of reason, and directors resigning out of the board, and only family directors are left in the company as of today. So looking at that, possibly there is definitely an issue in Byju. So I've just put it here. And Zilingo is another company which had financial irregularities. Go Mechanic was another company. BharatPay, we all know how much the board is suffering, and entire board, only one member is accusing against the other members irregularity, and vice versa is happening. So these are all the situation what is there currently in about the either startup world or the broader market. Everywhere, this is the governance issues which is there. This is very important for our topic because our financial statements is a reflection of the company, a reflection of the governance issue. Any issue, what you may think, okay, what to do with financial statement and governance issue? Once there is an issue, obviously you need to make some provisions, right? Whether your repayment capacity of the loan, you may need to look at differently. At least your notes to account should disclose this issue is happening. That's why whether our forecast is an issue. See, forecast is not directly an issue to financial statement, but only looking at your forecast, only lenders have given you the money. If your forecast you don't meet, you can't repay your loan. The interest what you need to pay, lenders have given you the money only because you grow. You grow multiple times, 10 times, 20 times, 100 times growth would be there. That is the reason lenders have given the money. So if you don't meet your forecast, you can't meet the obligations of loan or any creditors or any employee salary at least. So if you're not able to meet, then definitely there should be a disclosure. So all of these issues is having a direct impact on your financial statements. So that's why it's very important to know and understand the governance aspects. Whenever we are signing a simple companies, simple small company startup, or whichever balance sheet we are signing, we need to be conscious as to, can I sign this report? Is it okay? Is there any of all of these kind of issues which is there for the bigger company? Definitely to an extent it will be there. So what precautions I need to take to sign up the balance sheet? That's very important. So the left ones were Indian companies. Few of the names which you may have heard, I've put in the right, which is not in India. FTX. Anybody have heard about FTX? Nobody has heard about FTX. Okay, FTX was in the blockchain space recently. One of the most valued company, I think second or third most valued company in the blockchain Web3 space, that collapsed about 3-4 months ago, I think. Theranos, many people would have heard. It's somewhere into healthcare, some kind of research where the promoter claimed that they have already got the solution for a I don't know what they address, but for some, maybe you can think as some discovery of a medicine or something like that. They almost have got the fund solution for it, they claimed, and then they raised a lot of money, and then it got listed also. I think after 6-7 years they realized that what they claimed on the first day itself was not done, and no research has happened, nothing has approved. Their medicines cannot even treat anybody. That got realized after 5-6 years, after so many in different investors, so many bankers and everybody lent. Then they realized, and promoter also came out and accepted that, and the entire company crashed. Okay, this is something very, very funny. I felt, I don't know how many people have heard World Startup Convention, which happened in, I think, somewhere in Delhi or somewhere. So where this is actually not relating to financial statement, but I'm saying how many scams, how relating to companies, irregularities can happen. So this is supposed to be a convention which was supposed to be held in Delhi, and people like Sundar Pichai and all were supposed to come. That was what it was publicized. But on the day when it was supposed to happen, everybody started fighting on the place itself, in the convention itself, because whatever they assured, nobody had come. And they had taken up high big ticket entry fee, I think $100 or something like that. So everybody paid that money to see that some convention will happen. Convention was there, center was there, place was there, people were there, but only maybe some 10 people who were very, very premium, they were not there. I mean, that's the difference. But still, entire thing, and people like Ankur Warikoo and a few other movie actors also, and those are the people who had endorsed it. So why I'm giving this example is for this last statement. You don't know whom to believe, whom to not to believe. Every other kind of person who, Ankur Warikoo is somebody who has very high repute in the startup world, and I don't remember the names. First few celebrities also had endorsed this event. And finally, when somebody like that, let's say if Amitabh Bachchan is talking about something, and of course, whatever they speak on ads, it's definitely bullshit. You can't take it to it, because that's a different thing. But at least if as simple as a convention is happening and so is coming, if a person makes a statement, a celebrity, you will end up thinking that yes, that should happen, right? Unless very, very strange thing happens in the last moment, it may happen, but otherwise it will happen. But not even one person who were a very big name who were told that he will attend was not attended in that. So even though it is not relating to financial statement, that is very close. Anything can happen in the corporate world. I don't say startup, because even in the big corporates it will happen. It is just that it will be masked in such a way that we may not know much. So about all of these things, there are various talks which is going on. I've been part of many of these forums. Some of the investor forums I've been part of, and some of the founder forums have been part of. Some of the CFO forums have been part of. And in that, a lot of brainstorming is happening as to what do we need to do this issue on this governance issues. See, it is not as straightforward, as simple, because one may say that in one of the forums, somebody was saying, okay, regulations should be increased. We need to make very, very strict regulations. And that's why it has to be, that is a way in which you can address the issue. So definitely that is the first thing comes up, right? When there are so many scams happening, people will think that, okay, definitely there should be some issue in the regulations. But we should know whether there is a issue in the regulations, because we are the representatives of regulation. We should be knowing what the regulations say, and we should have a view whether regulations is right or not. But however, I'm just giving a glimpse of, when somebody says that, okay, regulations needs to be strengthened and all of this, just few examples. FEMA has a pricing guidelines issue. So there is a way in which you can come out. Of course, later it was fixed, but you do rights issue, no big deal. FEMA says you need to follow pricing guidelines. you do rights issue. For rights issue, pricing guidelines doesn't apply. You do rights issue, and that person who will allot, the shareholder, he will renounce his right to a new party, third party, and he will take the shares. Everything is within the law. Nothing change. I'm complying entirely as it is. Companies Act provides for renunciation. I will issue the shares to the existing shareholder, for which FEMA rights issue pricing guidelines will not apply. And that existing shareholders will renounce his shares to a third party who is supposed to be the investor. And without following pricing guidelines, I've allotted. I've followed Companies Act, I've followed FEMA, there is no issue at all. I've complied with law. So then obviously they need to make the regulation a little stricter. So they brought in whatever adequate amendments required in FEMA, and now that is not possible. Then round tripping was an issue. So round tripping is not possible. I don't know how many of you know, money cannot go out and come back to India without approval from RBI, and wherever there is a round tripping case, RBI will not approve. So practically you can't have a structure, an Indian founder cannot have a structure where money is going outside India and coming back India, even though business sense wise it may be required. Many businesses may be in such a way that fundraising will happen in India and you need to set up some subsidiary outside, and then that has to come back to India. Even though if it is your business requirement, it is not possible to be done in India. And some of the cases, okay, this is in case of even though business requirement is there, it is not possible. But 90% of the cases, people wanted to do this because of taking tax exemption. Let's say you make a company in Singapore, send all the money to Singapore and take that back in India. So Singapore treaty gives the capital gains exemption. So you do the business without having taxation. So that was I mean, I'm explaining it very simplistically, but now Singapore is not there, like the treaty is little more strengthened, but in 2012-13 that was very clearly possible. You know, the famous case of Vodafone, where they completely exploited this treaty, and then what government did, all of that, a lot of measures happened. But what I'm saying is round tripping was not allowed for financial reasons, not taxation reasons. For financial reasons, I mean, RBI wanted to ensure that round tripping doesn't happen, but there was a tax benefit also by doing round tripping, and people started doing it. So then there are some curbs which has come into that. Then then the other example is crypto. India as a jurisdiction is very, very restrictive about crypto and all of that. So, okay, India is very restrictive, but as a market is very attractive. So what you do, you externalize. You are a company which is there in India. So you externalize. Externalize means you are there in India, but still you try to ensure that you are there outside India. So externalize yourself, incorporate a company in Dubai, move everything there, and you start working whatever you want you do, because RBI had the restrictions. Now you are a company which is there in your legal entity is there in Dubai, but promoter is there, investor is there, everybody are in India, but legal entity is there in Dubai. So it's a starting stage. So no capital gains, nothing. Also, you have not paid big money. So you just moved your base there. No regulations apply, whether you want to make Web3 or you want to generate coins or you want to trade in NFTs. You can do whatever you want, just relocate the company to Dubai. So then there was some more stricter laws on that, and but income tax stood up and said that, okay, in case of your externalizing, capital gain will come, even though as per the base laws of the books, base laws of income tax provisions, taxation is not there. I'll still take your funding valuation, because as per income tax, when a share transfer happens, even as per rule 11UA, the way valuation mechanism works in income tax rule 11UA is equivalent to net asset value method for equity shares. So actually tax should not apply if you externalize, and that's why people could have externalized, but then tax authorities issued notices saying that, okay, even though 11UA says, even though this is the way, you have got funding at a higher value, so I'll assume higher value as your value. So, and levy capital gains tax. So tax authorities told that. So, okay, if tax authorities say that, then we will not directly externalize. We'll create another parallel chain. Okay, my company A is there. Actually, I wanted to externalize into Dubai. So if I transfer my shares, then tax authority will say that you pay tax. So I'll not move shares. I'll create new company in Dubai. Same promoter, same investor, everybody will create new company in Dubai. And that new company will create a subsidiary in India. And this existing old company will just do a slump sale or something like that, and then move all the assets at book value. And I'm done with it. No transfer of shares happened at all. When there is no transfer of shares happen at all, there is no way tax authorities can tax you. So I don't know where to draw a line, whether regulations should become more and more stricter, or people should take more responsibility. Both will not happen. In my mind, a businessman's business is to do business in the best way. If it is not possible, definitely shareholders will not be there with you. This was very, very hard. In a hard way, it hit to all of us when the recent layoffs happened, because earlier people were trying to give a color of something else to give layoffs, but recently when it happened with Google, Meta and all, they were almost directly they were saying, my shareholders are not agreeing. I mean, in any shareholders will need higher return. It is very clear to me, out of 1 lakh people or 2 lakh people Google has, 10,000 people are not useful. So I just want to move them. There is no big deal in that. It's just my business decision. It was as direct as that when Google and Amazon and all communicated. It was as simple as that. If I continue to hold these employees, my profits will come down and my shareholders will not be with us. They'll sell my shares and buy a competitor share. So I need to lay off. It is as simple, very simple business decision. That is the way it was portrayed. I'm not saying whether it is right or not. I'm nobody to judge whether layoffs and other things is right or not, but that is what is the reality. We can be thinking that, okay, emotionally we can think that it may be right, it may be wrong, but at least today everybody have come to terms that a company means, a shareholder means, that is their need to expect higher returns, and I expect higher returns, and you better do it. And anyway, I'm not doing illegally, nothing I'm doing illegally. I have not told my employee that I'll have you for 10 years. I need to give 1 month notice period. If I don't want you, I'm giving 1 month notice period and I'm completely squarely within the framework of law. So I don't know where to draw reference. Where to draw the line, whether basically everything should happen, or maybe in the other way, government also should do better, corporates also should do better. That's the ideal world. But the realistic world is nobody will do better. And even if that better is done, there will be some other way. If as I showed here, every time when one step is taken by the government, there is a way out in which you do the same thing by avoiding tax or by avoiding FEMA or RBI, whatever. So this is what it is. We need to just, as a layman, I may think that, okay, government should bring this stand, this should happen, that should happen, or the CFO of the company or the CEO of the company should be a little more emotional, little more conscious about their society and employees and all. As a layman, I can think. But as a chartered accountant being there within the company, it is very clear to me that a CEO is there. His main duty is just to ensure that company's profitability is higher. Whether short term or long term is the only question. If a CEO looks at a very long term, he may think even the PR and public, how do they feel? That also they will think a CEO, and do not take too harsh decisions. But if a CEO's mindset is very short term, he'll just see this quarter's profits. That is the only difference. But a CEO's mindset, his basic duty, his dharma is to just earn more profits. So I'm very clear, as a chartered accountant, at least I'm very clear, this is what the company will do. Whether it is right or not is left to anybody's discretion, but that is what they'll do. That is what will happen, whether it is right or not. And as a regulator, we know how difficult it is to frame laws. And whenever there is a law, we know how difficult it is to, keep track of it, how many amendments it will happen. When some amendment happens, like I've shown here, how people will react and try to circumvent that. So being a chartered accountant, I'm very clear. I'm very, it's not very difficult to understand how easy or difficult it is for regulators to make the law. Again, here I'm not making a judgment that regulators will doing 100% justice. Definitely, we all are facing the MCA issue. We know how good the regulators, how good they're doing, subject to all of that. But I know that that's the fact. In the last 30 years, if you see, I don't see there was any better way of drawing the regulations or implementing the regulations. That is the way it is. There is no second thought about it, whether it is right or not. That's the way it is. So this is what we've been. At one end, investments, valuations, transactions happen in the way it will happen. Corporate CEOs will behave in the way they behave, and we will not be so much in control as to what is happening. And on the other end, regulator, stakeholder will expect that we need to bring fairness in the financial statements. It is all what is happening in the corporates, and one end it is all what is happening in the regulations, but everybody will expect that chartered accountants will need to bring the trueness and fairness in financial statements. So finally, what happens, 2 years, Deloitte waited and then they resigned and went in by juice. So, there is no clear right, wrong here, but at least let us be conscious, let us be aware as to what is closer to reality. Instead of judging whether it is right or not, at least I'm aware, this is the reality. After knowing all of these things, maybe I'll be a little more careful in signing a balance sheet. At least I expect another disclosure, or I expect a few more line items in the management representation letter when I take from the management before I sign something. So these are all the only caution we can exercise by understanding completely what is the reality. And outside my office hours, definitely we can think what is right, what is not right. But within my office hours, I'll just see this is what is the fact, this is what is the industry, this is what is the regulator. I am obligated to give a report in this, whatever is the expectation, and what caution I can exercise. Only this much I can think from morning to night when I sit in office. So any thoughts till now? These are few slides I wanted to have to ensure that we are seeing the world as it is, we are seeing the profession as it is, we are seeing the clients as it is, without having any preconceived notions. Any reflections you want to make? Any 1 or 2 minutes, maybe, if anybody has any thoughts, any reflections you want to make, we can spend a couple of minutes and then move a little bit core of the topic. Please feel free to, come back, express anything you feel. Sometimes when I feel that it is very simplistic thought, but many people would have missed even that simplistic thought also. So don't hold any of your thoughts. If you're thinking something, please express, which may benefit everybody, please.
What happens is with the startups, not all instances are where the basis of valuation is not there. Sometimes chartered accountants also may not be, used to this DCF valuations, and they're not very accustomed to that.
Correct.
So they are still with a traditional net asset value basis the balance sheet.
True.
So that outlook is not there prevalent everywhere. Means all chartered accountants. So they may not be able to see there is true and fair value.
True.
Whereas same way the startups promoters may feel there is more promise than what they're even at all points of time. The promoters feel that they are being undervalued only.
Yes.
Even at that high valuation, they still feel there is more to come.
Because one life, it is one sweat. How can you value my sweat? It is always unlimited. That's the promoters thought.
And even the business that they are, people are more looking towards getting market share rather than seeing profitability in the short term.
Yes.
All those aspects are there, which balance sheet does not show.
Sure.
So
Certainly.
that
What's
was
your
my-
good name, please?
Rohit.
Rohit. Very, very valid point which Rohit brought in. Yeah. He wants that.
Yeah, hello.
If you can just hold on 1 minute, Rohit. Amongst what you told, most of the things there are in one way or the other covered in the subsequent slide. We'll discuss about that. Other than that, few reflections. DCF is the today's thing and net asset is the past. This was maybe 15 years ago. Actually, DCF is past today, because any company which is valued, even we saw, right, RIL we saw, if you apply DCF to RIL, you are coming at 8 lakh crore valuation. You're not coming to, let's say, 17 lakh crore. So already it is all outdated. DCF is also outdated already. That is the pace in which, the economy, the country, generally the businesses are moving. We need to, at least whatever efforts possible, we need to put in to ensure that we are little more reaching there, or maybe if possible, we can move ahead of that also. And ensure that at least if people are thinking that NAV is the today's generation, definitely you need to do a lot. If you're thinking DCF is today's generation, at least a little bit you need to do it. But anyway, you need to think a little more forward and forward looking, please.
Yeah, see, I am into basically audit and direct taxation. In my experience of last, say 10-12 years, so I have handled some big real estates out of Bangalore and some spinning mills out of Tamil Nadu, which is a listed company. So what I have seen overall, a private company, which is a very good, it had a very good basics. Foundation was good. They were the first high-rise building. They came with high-rise building in Bangalore. Okay, that was the first company that went into doldrums. We as auditors, we were witness to that. Lawyers were witness to that. Company secretaries were witness to that. What was happening, everybody knows. Everybody is blindfolded intentionally, because everyone want to save our bread for the day.
If you don't mind, I understood your question.
Even the brand, okay, the Great Wall was the brand ambassador. So everyone knew, okay, something is not going properly. So, but it's like all are hand tied. Everyone is knowledgeable, intellectual. But it's the ethics of the businessman only is the thing which matters. The market or whatever, why the market crash. No regulator, no auditor, no consultant can go overboard, risking his this one.
Yeah.
So my experience.
No,
So
no.
it's like everyone knows wrong is happening. Keep quiet. Your
No,
bread
no.
is safe.
Okay,
But reality. I'm telling the real
no,
word.
no, I got it. So, see, firstly, thank you for bringing your good name, Pradeep. Thank you for bringing this, Pradeep. It's a very, very valid way of looking at it. But slight things, let us be very clear that a businessman's business is to do business in a way that it will fetch a maximum value. An auditor's business is to ensure that whatever we see, we will not hold back and we will give the true reflection. Possibly, let's say Byju's case, Deloitte came out and now the BDO has been appointed as their best effort is to see whatever that comes to in the true way they'll reflect upon. So let's be clear that, okay, at one end, we will not assume that, okay, everything is on our head to ensure the correctness in the market. On the other hand, we should also have the basic sense that if something is very, very wide open and clear, a layman only can understand, and you are going ahead and signing, means that is also just not acceptable. Someday or the other, if not one transaction, you may get escaped, but definitely if you think about the entire lifespan of a chartered accountant for about 25-30 years, definitely somewhere you will suffer. For the short-term gains, one should not be, it's just a purely my personal opinion, one should not be going behind just a 1 year fees or 2 years fees or one balance sheet signing if something is very, very outrightly clear. And I'm just saying something outrightly very clear, you should not take. But in my view, even if it is vaguely also some issue is there, it is better to ensure that you ask multiple questions, go much deeper in it and understand whether it is whatever my thought of some issue could be there. Definitely it will be solvable. It's just that we need to give little more attention and spend time with the promoters and understand what is it. We will know whether it is black or white. From the distance, it will be gray, but if you go a little bit deeper, definitely you'll be able to make out whether it is black or white, and then take a call whether you need to sign or not, and have all the documentations, whatever you've done. Even though, see, something is outrightly wrong, definitely it is very clear, you don't enter. If something you don't know, maybe we can make a lot of efforts in going a little deeper and understand what is it, and at least our documentation paper will protect us if something goes wrong. So maybe that's what I feel, but definitely there is no point in thinking that, and mind you, looking at it in other way, only because of such high ambitious businessmen only economy will move. If everybody will become conservative, the economy will also not move, but everybody should know as to where is the border. People should be high ambitious, businessmen should be high ambitious, but they should just know where to stop, to what extent that can be accepted. So yeah, maybe I think a little more. So the stakeholders we already discussed, I'll not spend too much time on this. And what is required by each stakeholder will require very different things. Possibly we can run through this, maybe this presentation would be shared and we can run through this later. So after looking at all of these things, what an auditor is looking, or what a CA is looking, or what an accountant is looking, what requirements are there in our day-to-day life, we are just doing what is here, right? What is the policy, what is the law, what is the standards, what are the regulations, accounting standard, income tax, GST, employees laws, labor laws. This is what we've been doing all our day-to-day life. But looking at, reflecting on whatever we discussed, I think after complying with everything also, whatever we were expected to do also, I don't think there'll be 100% satisfaction, justification for ourselves. Okay, all of these happened. Let's say for the startup, what I was working, I complied with all of these things. If tomorrow that company gets closed down, I will get a feeling, okay, what did I do in 3-4 years? I was there with the company and all. But if I feel that in the same example, if I feel that, okay, 3 years back, I had given my voice, at least to the founder, that you're going too aggressive, or there is a small violation in the law, but don't do that. Even though that's a small violation, you don't do that. Maybe it will take little more efforts. You just better comply it off, or maybe take one more certification, or maybe you delay slightly and get your books right and then do it. If I have taken even one of these steps at least in the last 3 years, I'm talking about a scenario where I'm an auditor for a startup which ran for 3 years and then busted. So we may think that, okay, in spite of complying with all of these things which I'm expected to comply, why is it happening? Or if we have at least taken few steps in the last 3 years, definitely we'll feel very happy about contributing to the company, where even though its company died, But so many instances I had pointed out, I had stopped, I had at least tried to enlighten the promoter. Some steps I've taken. I'll feel very, very happy about that company, even though my client died. The company, even though it is closed, I'll feel very happy about where all I took the right steps in at least trying to prevent, defer, minimize the damage which was possible. Maybe we can just skip this. I don't think it is very. So this is okay. These are few slides where I've tried to. I thought I'll cover about the ratios, because ratio analysis is something we'll not spend too much time. We'll see that accounting standard is complied, Income Tax Companies Act provisions is complied, and we are good with. But real fun is there in financial analysis, a little bit time in ratio analysis, and giving the feedback inside to the company's promoters. That is where the true idea lies. I'll skip a few of these slides. After that, a little more interesting slides are there. Okay, just I'll spend a little time on this. When we talk about ratio analysis, it is also linked to the market price and other things. If you see, this is the analysis of Infosys and TCS. Both are very, very similar companies. Hardly any differences there between the type of their operations. Both are Indian companies, both have similar employees, both have similar markets, both have similar size, even though TCS is much bigger, but it's not like 10:1,000 we are saying. It's both are very, very similar companies. So if you see, always in the last from 19 onwards, if you see every ratio, every accounting ratio, financial ratio, TCS is outperforming in Infosys. But you can also see the trend that both are in a similar range. It's not very, very out of the range. So this is just to show that the matured companies, once the companies reach maturity, in valuation also we use this norms. Once a company reaches the maturity, you can generalize the inputs. Whatever you inputs you use for a company to value a company, you can really generalize. Let's say debt equity ratio. When you compute valuation based on DCF, if you need to take debt equity ratio, instead of taking the debt equity ratio of the subject company which you are valuing, actually you should take the debt equity ratio of the industry in which it is operating. Because it is expected that on a longer term, industry debt equity ratio will prevail even in your company, even though management doesn't know it. But actually, that's the fact that will happen after some 3-4 years. Industry debt equity ratio will become your company debt equity ratio. So that's the underlying assumption, which is also true. So this is just to show that how a matured companies, two matured companies will look like. All the ratios will be somewhere around there. Let's say operating margin, it is very close in all the years. Gross profit very close, just 1.5% difference. Net profit was 1.5% difference. So if you see, all the ratios are very close. So this is two takeaways from this slide. If you see, all the ratios are very close. So industry data, industry study is very, very important as an auditor, because even though I don't know much about the client, as long as I know how this industry works. Let's say real estate industry, the basic things. When I'm doing an audit of real estate industry, I should know the basic things that it can operate only through debt. Capital will be less, debt will be high. There will be multiple SPVs. Each project should be there in a different SPV. These are very, very basic industry norms. I must know it. In one of the audits, I remember in a real estate company, there was one insight from our internal audit team, where nobody can imagine that could be a very useful point. It is just the exercise of testing the interest computation on the loan. Whatever is the interest which banker has told, let's say 7% or 7.05% or 7.04%, whatever is the percentage, in the way it has to be applied, monthly compounded or whatever it is applied, we have a bank statement. We just thought that even we didn't know that, okay, there could be thing, but we just thought that, okay, there may be some issue. It is not that it is visible also, because somewhere around there only interest amount is right. 7% means that should come, but we just thought that there could be difference. So the difference was to the extent of about 3% of the total interest component. It was about 1.5 crores difference. It came to about 3% of the total interest component. You can't imagine such a, thing like an interest collection from a bank. Everybody, including management, was just assuming that this is the rate has been sanctioned. This is the rate it is being applied. All kinds of error were there. One is applicability, the way you apply compounding. There was an erroneous way of applying. And there was an error in computing different months interest together, and there were 3-4 different types of loans. So adding up errors were there. So all kinds of errors was possible. About 3 to 4% of total interest payout was saved, and that 3 to 4% is also about 10% of their margin. So knowing about the industry, the way they operate is very, very important, because what is an industry company is also mostly true in the same way, in the same direction it will go. That is one thought in this. Another thought which came to my mind was when we were saying accounting ratio and all of that, we spoke, right? Unless we do complete circle of it, we can't take a decision on whether the value of the company is right or not, whether we can buy that stock or not. Some people spoke about books, some people spoke about management, some people spoke about P ratio and other things. So unless we connect all the dots, there is no way when we can take a right decision. For example, in this city, is it very clear which company is, I mean, if you want to buy Infosys or if you want to buy in TCS, if you have option, which one you buy? Infosys, TCS, anybody feel Infosys? Nobody thinks that Infosys? Both. Okay, if you have option to buy one out of these two. TCS. So just say the next input. Infosys P ratio is 22, TCS in P ratio is 28. So even if you miss one aspect, you are bound to take a wrong decision. So yes, exactly. So before anybody could have thought, if you had thought, then you could have made a decision. Now you thought after everybody thinking P ratio is already high. So, I mean, this is an example to go through completely into a company and see that, okay, what analysis we are doing while either we are buying or talking to somebody, which one to be bought. Very, very simple. So that's why I told, in my experience, nobody can make money in a justifiable way for the amount of what is required of time you need to invest and make money. I mean, just one more example. I thought that about 2008, I started investing in markets. And I thought that first 3 years of my investments, it's very, very good. I didn't trade in F&O, but normal investment by some companies, my broker, those days it's a physical broker. You talk to broker, they'll say something and you buy it, you sell it. And I thought that after 3-4 years, when I see some 30-40% gain was there, I thought I'm a successful investor. I've got some kind of trick. Maybe what I thought that time was I'm not too emotional. When I had profits, I just booked the profits. I was not too emotional like others who held on and then incurred loss. All of this was my thinking. But then after a few years, I decided that there was nothing great in me. It's just that entire market moved up in 2008 to 2009 to 12, 13. Nobody could have lost money. Whatever company you invest in, I mean, little saner companies, you will end up making money. There is no way you can lose money in that market, 8 to 12 or 13. So in that way, my experience is it's not, I mean, it's not wise to spend time unless you're a professional trader or an investor.
Whatever you invested on March 22nd of 2020, it would have crashed by 20%.
Yeah, so it is in 2008 now. So 10 years, it would have increased by 300-400%.
That's question of it's not. There are many other parameters, right?
Yeah.
Not just
But the summary is it worth for us to, I mean, apply so much time and efforts, and we know that market is better knowledgeable than me, and so much data is there. Definitely, it is impossible for me to decipher everything and take a call on a particular company.
there's something called gut feeling.
Yeah, gut feeling and luck, anything can happen. That is always there. Yeah, correct. So it's nothing but luck, right? In the markets, in the business, gut feeling may be something more than just a luck. But in the markets, gut feeling is almost equal to luck. Yeah. I don't know. That's why I paused. I don't know. But the way they handled the situation was excellent. That is the best way they could have done. We need to see whether that is okay or it will retain or not. Sorry? Yeah. That I mean, that issue is there. That's the risk of all the shareholders have taken, especially who have taken a, I mean, long position at 4,000. Definitely, they would have lost their money. Yeah.
When it starts, when it sell 20-30%.
Yeah, you will buy. Yeah. Correct. But there are many companies which did not even rise, no? Like, for example, Kingfisher, it was in a similar position. It fell from so much. Educom is there, which all fell from their heights and became almost zero. I have bought Kingfisher. I thought nothing can happen in this company. There are only 4 or 5 airlines. What maximum can happen? It fell from, I think, 60 rupees to 11 rupees. I thought nothing more can happen. It was in 2011. I thought nothing bad can happen. There are only 4 or 5 airlines. Something Malia will do and something will happen to the company. And today it is 1 rupee. Yeah, many other, West Bengal. So with, I mean, looking at both accounting standards, ratios, fundamentals on the one end and the market in the other end, just a little bit, some thoughts as to a little bit reframing or reassuring what we discussed. Just look at this company, what we can value. So since the time we have is very less, I'll just move ahead by not taking answers, but just self-explaining. So this is the balance sheet. Total balance sheet size is about 5 crores, and net asset is 2 crores. This is the balance sheet. Can we value this company is the question. So if we are very old school of thoughts, we can say, yes, we can value this company with this information, 2 crores is the value. But if we little bit think through, we'll think that, okay, we can't value, we need some more data. What is some more data? What is missing here is the revenue streams. We need to know what is the revenue. And next is what is missing is what is the founder. Somebody rightly pointed out management team, and we need to know what is the founders, what is the IP which is there. See, one basic issue in any balance sheet, any financial statements these days is the, I mean, very nature of it, right? The conservatism. That is the way the foundation principles of all our standards is conservatism. In any way will it work, conservatism? In any way can it work in the real world? Because real world decision will happen based on what is likely and what is unlikely, not based on what is conservatism, right? This was one of the topic we were debating in evaluation. So it was about the tax rate, what we should apply in the future next 3-4 years. So if the company reaches certain stage, the tax rate was a little different. So the question was, as a valuer, should I adopt a tax rate which will give me conservative value, or I mean, almost the team had decided that we need to apply the tax rate which will give conservative value, because I'm being a chartered accountant, always I'm trained to think conservative. But then we thought that definitely it will be wrong if I apply a tax rate of conservatism, which is what more conservative. As a valuer, I can't apply that. As a valuer, I can only apply what is more likely and what is not conservative. If the management feels that, and if I also agree that the company will reach a particular stage of turnover after some 4 years, then definitely I should take a tax rate which will apply after that turnover. I think you're getting what I'm saying. There is, let's say, I think 22% or 20% or some rate, I don't know the right rate. That percentage will apply after a turnover. And after the turnover, your tax rate will come back to 30%. So as a valuer, if I take 30% tax rate, thinking that is the most conservative view, because more tax rate means lesser profits, lesser valuation. That's a conservative way of looking. If I take that call, I would be wrong as a valuer. Even though I'm signing as a CA, but I'm signing as a CA, signing the valuation. I'm taking the shoes of valuer. I'm CA plus valuer. So I can't take a conservative stand. I can only take what is more likely. If the company is expected to cross the turnover, take 30%. If the company is not expected to cross the turnover, then you should take 22% in the projections what management is given. So likewise, I mean that what I was trying to explain there is all our regulations, laws, everybody just talk about conservatism, and there is nothing more than that. The way you recognize profits, the way you recognize capital gains, the way you value the inventory in your books, everything is based on conservative. The way you value fixed assets, only IFRS little bit brings about the flavor of market value, but there also it is fair value, but there also it is not total fair value. That is also inherent principles of conservatism, but it at least a little one step better that you're also cognizant about what is fair value in IFRS. So that is main thing which is missing in this balance sheet also, which will make us not able to anybody not take decision, where an important aspect IP, which is there in every startup. For example, that's why I wanted to bring the Flipkart balance sheet, but I could not get it, where it would have been very clear as to what all cash burn has happened. Even though total cash burn has happened, which is not there in the balance sheet at all, it will make your balance sheet very low. But actually, even though your balance sheet is very devastating because of cash burn, investors are valuing more because they are not looking at cash burn as cash burn. They are looking at the IP which is created. How many vendors are there in Flipkart platform? What is the technology which is there? How many customers are there? What is the logistics and last mile delivery the Flipkart has established? Those are all the assets for an investor, which nowhere can figure out in a balance sheet. So that is the IP which is be missing in our balance sheet. So that's why we will not be able to take a call based on balance sheet. So what next you need? Revenue, of course, which was not there. Anyway, it will be there in P&L, but that's the thing. So gross margin to net margin, these are all very key aspects. We can discuss a lot more interesting aspects about it, but for the shortage of time, a little bit move quickly. And then much more, more than revenue, we need what is the forecasted revenue. What do you do with the revenue which is already incurred? It's a dead thing, dead information, right? Already I want that revenue that is there in the balance sheet. It is not important. But what is more important as a stakeholder is what is the forecast the company has to, capacity what the company has to earn revenue. And once that is known, what is the total market capacity? What is the total market available for this company to earn? That is also a very key input for me to do valuation of that company. And out of the total market size, yeah, I'll come to this point a little later. This is non-direct market size and all of that, which we consider in valuation. So none of these above factors except the revenue is there in the normal financial statements, what we present, what we audit, what we prepare. I will just little skip. This was another example. I'll just skip this. Maybe this slide you will have it so you can see. So this is one more area which I had covered where to take one small sector and show how the financial statements and the way balance sheet will look at and all. It's a between OEM and VR. OEM is the original equipment manufacturer. VR is value added service provider. So what you see, let's say, I think Bounce and even Ather and all of the two-wheeler electric manufacturing companies are mostly just assemblers. Even though they call themselves as manufacturers, mostly they're only an assembler. Recently, I had an opportunity to work with a company, electronic vehicle manufacturing company, three-wheeler, that has an end-to-end assembly line, where only things like glass shield and tires, actual rubber tires, only except those few materials. Other than this, what they get is the basic steel and layers of this thing, what is required to build your chassis and all of that. Once those things enter your factory, the output will be an EV auto rickshaw and some ions for the battery making. Battery also they do in-house by taking the ions. So that is a manufacturing setup. Otherwise, what happens in most of the other manufacturing companies is they are not original equipment manufacturers. They are just assemblers. Tires will be made by somebody. Chassis will be, even chassis, which is a basic ingredient of the vehicle, will be made by somebody. Most of the brands which you see, they won't have their in-house chassis making. So it is just an assembly. So there are two ways of thing. I mean, it's not, again, don't go to, see, always one mistake we'll do is something when it comes through, we will try deciding whether it is good or bad. So I'm not at all inferring here that OEM is better or actual assembler is better. Both are good. It's just that in the way they develop their business. So this is about OEM and VR. What are those? So yeah, so if you see, as I was saying, there are many advantages, disadvantages for OEM and VR. But as an auditor, when I see the company, I should be very clear what company I'm valuing. Just because it is, let's say, Ather, I should not assume that it's a manufacturing company and I'm start applying the things what is required and do some industry research about how a manufacturing company works and all of that. End of the day, it is just an assembler. It does not even, I mean, have many features of manufacturing. And this is true to anything. For example, I just took the example of OEM, as simple as example of automobile, as simple as a mobile. So there is hardly any parts where let's say Xiaomi is one of the greatest, I mean, largest supplier of the phones. They hardly have anything in-house manufacturing. It is largely an assembly, which is what which they do. So at the same time, there is no degradation about it, but they could have done that much more better than any other semiconductor company. The way they branded Xiaomi, the way they distributed the products and all that, they did amazingly well than, let's say, a semiconductor company, which is one of the basic ingredients for a phone. So this way, while we approach the financial statement, while we approach the company, we should be clear. We should not go by the names as to, okay, this is and brand and bucket the company. Actual company could be something totally different than. One more example is coming to my mind. Somebody was saying that real estate they were handled. See, real estate is a very interesting area as a sector, as an industry. What all buildings we see, let's say Shobha or Purvankara or Mantri, all of these branded very big builders, they in fact don't do anything about construction, right? Those who have done real estate industry as audit, you will know those, they don't even, I mean, have any basics of civil and all of that, they don't even understand. They are the, Tata is one of the biggest in the construction space. All of these brands would have outsourced the construction to maybe Tata Construction or something like that, L&T, and those are the people who actually construct. Then what do? We all think that, okay, they have built and we are going. It's just about branding. They know how to very well, I mean, connect the sourcing, the vendors, the players who are there in other industries, connect them well, ensure that minimum time is taken for the construction, manage them very well, manage the employees very well, so that minimum time is taken in the construction, and do the marketing well, so that I mean, you have lesser period in sales, because in real estate everything about timing, because 90% of the value is coming funded by debt. So more the timing, more interest you're losing. So if you can do in the best timing, then you will make more profits. So these companies are very well known for managing the timing, managing the vendors, managing the systems, but they got nothing to do with real estate construction. So if we go with the mindset when we do the valuation or when we do the audit of this company, well, if we go with the mindset that okay, construction activity is going on, then all of our assumptions, all of our theses, whatever we want to check will go wrong. So this is also another example where we can be alert and as to thinking what we are approaching, what balance sheet, what client we are approaching. So this is another very, very interesting example. I took the this thing of Maruti as an example. So this contrasts and draws out very clearly as to what happened in the world of automobiles. See, 2019, I did not want to go beyond 19, because if you go beyond 19, we can't even, we can't even think, think logical comparison only is not possible between Ford and Tesla. I've taken a comparison which seems little more saner from 2019 to 23, but if you compare, just try this exercise, compare the numbers and ratios of Tesla and Ford from 2014, we will get flabbergasted. So 2019 gross profit of Ford was 12,000. I think these are only $1 million, and net income was 47. Okay, this slide doesn't have value. I'll move to the okay, this number just shows the gross profit, operating income, net profits, and all of that. And I'll move to the slide which shows the value. See, 2014, the total assets of Tesla was $82 billion, and this was $255 billion Ford value. In 2018, if you see, Tesla's total assets were 29 billion and Ford is almost same, 256 to 255 in the 4 years. If you see the sales, $21 billion, this was $160 billion Ford, and the value Ford with $160 billion and $250 billion asset, Ford value was 31 billion. And with $21 billion sale and $29 billion assets, Tesla value was 57. Just 10% of asset value, but double the market value of Tesla compared to Ford. And just fast forward 22, it is still about 20% of asset value, but the market value is 10 times more. And today the market value is even 15 times more or something like that. So this is another example where what to do with the financials, what to do with the market value, totally contrasting, totally different. So Tesla is a single point of reasoning. EV as a general, but large share of EV goes to the Tesla's advancement. So that is where maybe most of the people would have lost money in, let's say, buying Maruti Suzuki or something like that, and drawing the reference that to the financial statement. Even as an auditor, we could not do anything at all by looking. If we are auditing the company in 2014 Maruti, don't think that Maruti is okay, only few people will do, only big fours do all of that. There is a lot of other companies in the automobile space. We might be the clients which we are valuing, but we will definitely miss out, and nothing can be done. As somebody was saying, as an auditor, I can't do much at all. Definitely, I can't do much at all. We can't foresee EV coming up when the shareholders and investors themselves could not foresee. But whatever is possible from our end, definitely we can do it. Knowing what is the current things, knowing what is happening in the industry, knowing exactly what is there in the space. For example, NVIDIA. I did not hear the company name at all until 20 days back. That's okay. But I represent many of the semiconductor companies I work with, and I work with many of the startups. I should just admit that I didn't know. That's all. And today I know it. At least today I know it. So at least be aware of what is happening in the company. Even today, if you have not heard of NVIDIA, and if you're working in something company which is into AI or is into semiconductor and all, then there is something for you to do it. So I think this is the line where we can draw. We can't know everything, but definitely some efforts can be made to know about our clients, their industry, and things like that. I'll skip that. Okay, so this is something to just show, as I was saying, a little bit better we can do, a little bit more we can do than the regulations what gives us to do. For example, if you observe this, simple things added in this, gross revenue, always it will be there, but just seeing in what way revenue has grown, 18% it has grown from last year to this year. This is very simple. It's not a new concept or something very different, but can we, when in our discussions, can we present just one more additional column where it, apart from just saying that this gross revenue is right, I have seen the invoices, I have seen the GST returns, I have seen the income tax return, I have seen the TDS return. So I'm 100% sure the revenue is only this much. That is one stage. Can we go little more and say that, okay, apart from that, I've also seen the last year what happened, and this is the comparative, and this is where you're moving ahead. This is where you're stepping ahead. If we can give this very simply achievable insight. So other things, when you see, okay, this is something which is very standard in any B2B, D2C companies or e-commerce companies. You can't just do anything in analyzing a company by seeing gross margin and net margin here. In between gross margin and net margin are the indicators which we have learned to analyze and see as an accounting ratio, but really nothing can be done by seeing these two. Gross margin will be same across the industry because everybody D2C, I mean, these are e-commerce players or the e-commerce brands are the brands, which is another example for OEM kind of. Everybody, let's say you would have known about Mamaearth, you would have known about Sugar, Cosmetics. So again, they're just brand owners. Manufacturing, somebody else is there who is doing the manufacturing. You are just a brand owner. So by comparing gross margin in those companies will nothing but revenue and what you paid to the manufacturers, outsourcing manufacturer. Your comparable company also would have given the contract to the same manufacturer, so your gross margin has to be same. There can't be a difference in two competitor companies in the gross margin. In this space, I'm saying, and not every company in this space, gross margin cannot be different at all. By just comparing gross margin, nothing more we are achieving. And so that's where the concept lies. Then CM1, CM2 it is called. So contribution margin 1 is something where this can differ between the companies. Gross margin is same, but this will differ between the companies, the way they have handled delivery, the way they have handled packaging. So with all of these things, the contribution margin 1 may change. And further, after that, the way they handle the marketing amount of expense, this is a very key indicator which any startup investor will look at. How much money they have spent in marketing and how much more sales they've achieved. So that will be visible in CM2. Contribution margin 2, it will be very visible the movement of CM2 as to how much money you spent on marketing, how much more sales traction you got. So these are basic few simple additions, which is very simple to add, but it is just the knowledge that how an investor is seeing it. If you know it, you can easily do this. So you see the way your promoter, your client your founder will look at you. If you just talk their terms, as of now, they'll be looking at that, okay, if this person comes, he will know which section 192 I need to do TDS, whether 206 AA will apply or not. So those are the things I will know. That's the impression promoter will have. But if you just go and tell him that, okay, your CM2 is so-and-so in April month, but in March month, it was so-and-so. If you talk, he will just feel like alike. He will just feel that, okay, there is a lot more wavelength matching, talking and other things. Just imagine how much more business you can get from them, how much more work you can do from them, how much more revenue you can achieve if you try talking in the same terms as the promoters. Balance sheet, actually there is not too much difference between noteworthy difference, but except the cap table, which I mean nowhere in the syllabus or in our traditional practice we would have learned about different series of capital cap tables, but that is the reality. Every startup will have different series of cap tables. We need to understand, know how the investment happened, how different instruments are there, how different series work. If we have that knowledge, then we'll be a lot more equipped to talk to a client in a very much more confident way. So I have only 3 minutes. So I thought I'll list out some things what a promoter will talk about. See, these are the number of jargons which we would not know anywhere in our syllabus as a CA or in our, if I take Income Tax Act, if I take Companies Act, if I take FEMA, whatever we read, these are the things, it's not end of it. I just, this first and second column, I just typed in Google to say a startup jargons. I got some 30. And after that, I started continuing typing what I generally use in my business beyond that. And some 4 columns came, and this is not end of it. Another maybe 2-3 lines we may add. So these are the things which is very, very common for any founder to use. So when we are talking to them, let's say, for example, TAM. He will say my TAM is 3 million. When they say if we don't even know what is TAM, next 1 minute I've not even understood what he told. If that term I don't know, next 1 minute conversation I don't even know. And in 5 minutes conversation, he uses 20 terms, 20 such terms. So entirely we missed out everything, right? So I thought I'll spend little time on this, but anyway, this is available in Google. At least maybe when you get this presentation, you can try researching on, I mean, what is the expansion of it, what is it means, so that if at all you're working with, I mean, mind you, this is not just used by startups these days. Every client who is growing will be using, even though they are the biggest of the company, smallest of the company, traditional kind of company, everybody uses these kind of terms. May not be everything, but a lot of it. So better as a professional, I'm at least aware and nearby to my client. Okay, this is something which I had added a slide. If there are anybody who are in the audience, if there are anybody who are starting their practice or trying to see in what new verticals we can move in the practice, what comes to my mind is this entire CA practice can be bucketed into this. One is books of account. Either we are doing the books of accounts or reviewing. Then compliances, it includes all the compliances, either we are doing or reviewing. Then advisory and the above. Doing or reviewing is different, advising is different. I can review and say that you met the compliance or not, but to advise as to in what way it can be better complied, or it can be, you can gain as a businessman, is a different advisory capability. Even though the advice is on books only, on compliances only, still we can have, I mean, all the traditional practice, it's very, I'm very, very clear. When I was doing articleship, my principal, he was very, very clearly, I could make out what advisory he does. Even it's an individual practice, individual return filing, partnership return filing kind of thing. He just exactly knows what is the percentage of expense allowed by that. This range, this circle tax officer, another circle tax officer, what is the comfortable range of allowing the expense? This could also be an advisory. And it need not be that very, very top end McKinsey Bain kind of advisory. Even as basic as this also could be an advisory. If I start looking at differently at advisory, I can raise one more invoice apart from just raising invoice for tax return filing. If I can be conscious that, okay, apart from just filing your returns, I'm also giving you the advice, we can bucket that, bundle that in such a way, and then we can also ensure that we will actually do justice for the knowledge what we have. So advisory in another line of practice. Industry research, business research is another. I'll come to this. I'll come to this later. Valuation, I think everybody knows. Transaction advisory and tech-based and other geographies. These are the different bucketing I did as to what an opportunity could be there. I'll come back to this in 30 seconds. So while knowing all of these things, I thought of sharing for the entry professionals as to what is required to set a very good profession out of this. First, subject matter of expert. We need to have the goalpost where we are going. We have set up the office, but where we want to go, what we need to do, that vision should be there. Network and connects, from where work can come, not only clients, but somebody else can also give the work. We need to have that awareness. Trust and recall, once we have worked with the company, that promoter should be able to, remember us and call back, let's say after 2 years also when he has other requirement. Organization, after doing all of these things to scale up, you need to know how you can manage your organization and team building growth. These are the things I thought it is required. Okay, coming back to this. So the first three things can be do immediate. Any CA who has just qualified can easily be able to do this. And the last four things is a long shot, not immediate. You need to, it needs some amount of time and efforts and having at least a good team of people to do it. So this overall, I thought one slide I'll share with people who would have just started practice or who are thinking of doing little more than what you're doing currently. So I think I've already overshot by 2 minutes. But if we can have, if anybody has question, I think few minutes we can spend, otherwise we can wind up.
Be a speed breaker for say Flipkart, Amazon, or
No, I don't think so, because for the established players, it's just not just about platform. As I was giving the example of Flipkart, what is not there in the balance sheet, what is not there in definitely platform, but also that the logistics network, what they have, the number of people who are there already in the platform, the type of vendors, the data, what they've got, the intelligence about the data, which city, which area, what people can buy. So all of those things also could be there. So it may little, I don't think it will too much influence or break, but definitely it is an opportunity for a lot other people But by the time it can be completely taken advantage, which requires another 3, 4, 5 years, by then they will also little evolve, you know. It's not a showstopper, but definitely an opportunity for others.
Some monopoly will be, it will reduce.
Yes, yes, to an extent, yes. Sure, I don't want to hold on others who are wanting to go for lunch. So maybe I'll be there for 5-10 minutes. If somebody has any questions, we can talk after this. Sure.
We all are one or the other way as employee or either as director or auditor would have involved in either in preparing financial statements or auditing or giving opinions, etc. As our immediate past president of ICAI, Dr. Debashish Mitra said, audit is a serious business. If you are not, be away from it. But we all will have to look into the perspective of all the stakeholders, be it shareholders, lenders, government, creditors, etc. What do they expect out of we chartered accountants? In whichever capacity we are with the organization. Was well upon by CA Chinmaya AM. A round of applause for that ice-breaking session. Thank you, sir. On behalf of members present here and all the managing committee members of Bangalore branch of SIRC ICI, we would like to hand over a memento to the speaker. Can I request a CP Jain, MC member, to hand over the memento to the speaker? Thank you. Now we'll break for lunch and then reassemble sharply at 2:20 p.m. for next session. Thank you.